New Zealand has posted its largest monthly trade deficit for October in 6 years, led by a fall in Chinese dairy exports, while all main imports into the country rose. To discuss this data and more coming out of New Zealand is market strategist with National Australia Bank, Gavin Friend. Welcome, Gavin. So let's begin with the New Zealand trade balance out yesterday. New Zealand exports fell 5.1%. Was this expected, and what can you attribute to this result?
No, actually, I mean the market was looking for an overall trade deficit of about 600 million, 650 million. Actually, it was about a third worse than that. It was at 900 million. As you say, exports were down 5%. We were actually looking for a declining exports of about 12%. So in that sense, it's a better result. And the detail, even though the trade deficit was worse, strangely enough, the detail was better. We saw that increased meat and seafood exports. I mean, the meat sector is something like about, alongside skins and wools, about 30% of Kiwi trade. That rose, especially to China, and helped offset a 24% slide in dairy. And that 24% slide is not a volume effect, it's a value effect, and it reflects the big slump that we've seen in the dairy price over the last since about February, so nearly a year now. If you look at this set of trade numbers, which for the month of October, the volume of, or rather the exports to China for dairy fell 40%. That was not, I correct myself, that's not a volume effect, it's a value effect. So that looks like a big slump, 40%, and observers might look at that and say, oh, this is a signal that China's demand for New Zealand's dairy product is waning, and it isn't that at all. It's simply the value effects of the big slump in the dairy price that we've seen over the last few months, which we expect to continue.
What was the market reaction to this report, and what impact could we see on the New Zealand dollar? Could the bearish momentum seen on Tuesday's inflation expectations continue?
Well, I mean, I wouldn't put too much attention on or focus too heavily on the reaction to the Kiwi today to the trade numbers. If you look at what's happened to the Kiwi, like the Aussie dollar, both of these currencies have edged higher today against the US dollar, regardless of what's going on domestically. And I think the driving factor for that rise in both those currencies was, as we saw yesterday, an unexpected and across-the-board decline in the dollar. Very illiquid conditions in foreign exchange markets heading into today's US Thanksgiving holiday, and probably, likely for most people in the US at least, a long weekend with Black Friday shopping at the end of the week. And every now and again in foreign exchange we get these kind of strange periods where there is the total absence of liquidity, and what happens is then the overriding positions get squeezed, and that's what yesterday's was all about. It's one of those periods where you couldn't really tie macro data to the prices or the price movements we were seeing in foreign exchange and other asset classes. So I wouldn't get too tied up in the rise in the Kiwi as a reflection of the trade numbers and or the inflation expectations numbers that you talked about that we got earlier in the week.
Looking ahead to Friday and business confidence, what are you hoping to see from this report?
The background to this is you've got a strong economy, you've got strong immigration flows. A lot of these people are coming in with work permits, visas, to help with the Canterbury rebuild. As I say, there's an absence of inflation. I mean, these are fairly supportive business conditions. If we look through the business surveys, the PMIs, there's every reason to believe that business owners would remain upbeat on the outlook. The question for us really is we understand if the RBNZ was underestimating the strength of the Kiwi dollar and that overestimated inflation. The question is, given all the strong dynamics that are being seen in the New Zealand economy, when is it that inflation will start to pick up? And therefore, when would the RBNZ look to get back into its tightening cycle? Because that's where it wants to go. It doesn't see the peaking rates at 3.5%. It sees the peaking rates somewhere above 4%.
Thanks, Gavin. Great to speak with you. That's all from me, but do keep clicking back to Dukascopy TV for regular updates and exclusive interviews just like this.